In this video, we're going to look at price discrimination, or the charging of different prices for the same products. Our first example is going to look at what we call third-degree price discrimination, which is setting a different price in different markets or different market segments. This one is actually a very straightforward extension of what we talked about in Chapter 13 when we looked at a single price monopolist. For a single price monopolist, we said that they will maximize profits by producing where marginal revenue equals marginal cost and then letting the demand curve determine the price. So with third-degree price discrimination, we just apply that rule repeatedly. We use it for every different demand curve that we're looking at. In our examples, there's typically going to be two. So here in this example, we have two markets, market A and market B. They have a different demand curve, which is necessary for there to be price discrimination. If they had the same demand curve, you just have the same price in both markets. The optimizing price would be the same. And so when we look at this, we're just going to apply the rule in each market. So in market A, we find where does marginal revenue equal marginal cost at that point. So we know that we want to produce 300 units in the first market. And then just like we talked about in Chapter 13, we go up to the demand curve and say, okay, the price is 10. So our quantity in market A is 300, and our price in market A is going to be $10. All right, so $10. Then we just repeat for market B. Where does marginal revenue equal marginal cost? Right here, that point there. So notice our quantity is going to be the same. Our optimal quantity in market B is still 300 units. The difference now, though, is the price. When we go up to the demand curve to figure out the price, we're only going to charge $7 in market B if we're a profit-maximizing monopolist. So now that we know the optimal quantity and price in each market, let's talk about profits. So optimal profits, as we know, are given by the following formula. It's price minus average cost times quantity. So in our first market, we know in market A, we know the price is going to be 10. We know the quantity is going to be 300. So then our question is, what is average cost? Well, note we have this kind of simplifying assumption that marginal cost equals average cost, so that's 4. So we take that and we get $6 times 300 units, or $1,800 worth of profits in the first market. Now, where do we see that on the graph? Well, notice our price minus average cost, that's just this vertical distance here between our price of $10 and our average cost of 4. Then the quantity, right, is just that 300 units. So this area right here is our profit for market A. Then we can repeat that calculation for market B. We said the price in this market's 7. Our average cost is still that same, it's $4. And we still sold 300 units. So what do we get here? We get $3 times 300. That's $900 of profits in this case, for market B. So notice we're making a lot more profits in market A. Why? That demand curve is more inelastic. We know inelastic markets, you get a higher price markup, you're going to get more profits in market A than in market B. Now, one thing we have talked about, though, is that arbitrage can break down price discrimination. So what would arbitrage look like here? Well, imagine if resale was possible. Then consumers in market B would just say, all right, I'm going to buy the product for $7, and then I'm going to turn around and go to the people in market A and say, hey, you don't need to buy it from the company for 10, I'll sell it to you for 8. So then all of the consumers from market A just buy these resold units at the lower price. They don't pay the $10, and the firm loses out on those monopoly profits in that case, right? Notice most of the profits are coming, the biggest chunk of profits are coming from market A. So if market A stops buying from the company and just buys on the resale market from consumers in market B, that destroys the ability of the firm to make profits from price discrimination. One final thing to talk about with the third-degree price discrimination is deadweight loss or economic inefficiencies. As we learned in Chapter 13, monopolists produce too little and charge too high of a price, which leads to a deadweight loss. It leads the economy to be inefficient. So you might imagine here, right, with third-degree price discrimination, we're just doing the same thing we did in Chapter 13, just multiple times, right? And so we expect there to be a deadweight loss in this case, and in fact there is. To find out what the deadweight loss is, just remember our rule for efficiency. Our rule for efficiency is given by price equals marginal cost, which means where the demand curve hits the marginal cost curve. So efficiency in market A occurs here. So the efficient market would produce 600 for market A and 600 for market B, as it turns out. So this is the efficient point. That's what's good for the economy. But remember, keep in mind, what the monopolist is doing that's good for themselves is not necessarily good for the economy. We have two aspects here. What does the firm do to maximize their profits? And then we analyze how does that decision affect economic efficiency. Here, the monopolist decision to what they choose to do to maximize profits does not result in economic efficiency. We already saw that they're going to produce 300 in each market, so our deadweight loss is going to be given by the sum of these two triangles. This one over here is going to tell you how much deadweight loss there is in market A, and this one over here is going to tell you how much the deadweight loss is in market B. Not going to run the calculations on that one. I'll leave those up to you to calculate out the deadweight loss in those two markets. So now that we've talked about third-degree price discrimination, I want to move on to what is known as first-degree or perfect price discrimination. For first-degree or perfect price discrimination, the monopolist charges every consumer a different price, and specifically their maximum willingness to pay. Well, we know that the demand curve is what captures a consumer's willingness to pay, and so basically the monopolist just marches down that demand curve, charging every consumer a slightly lower price until we get down to this point right here. Right? At that point, the monopolist isn't going to charge a lower price than marginal cost, because if they charge a price lower than marginal cost, they're actually losing money. But they'll start up here with this consumer and charge that first consumer $16. And then they'll just keep lowering the price to keep adding in more and more consumers. And they keep going till they get to that point. Once again, they won't go past that point where price is marginal cost, because if they end up charging a price lower than what it costs to produce the product, that loses money for them. So in this case, they've sold all these units. They sold all 600 units. And their profits, given our nice simplifying assumption that marginal cost equals average cost, is just the area of this big triangle. All right? So profit in this case, it's a triangle, so we have to put our 1/2 in there. Then we find the height of our triangle. Well, it starts at 16 and it goes down to 4. So our 16 up here, 4 down here. Subtract those, we get $12 there. That's the height. And what's our length? Here it's 600. 600 units sold. So that's $6 times 600, or $3,600 made in market A. In market B, the same idea, right? As long as the price is above, as long as they can sell it for more than marginal cost, they're going to do it. So they're going to charge that first consumer $10 and just march it on down till we get to this point. Beyond that point, they would be losing money by selling more, so they're not going to do it. So what's our profit? It's this area right here. So once again, it's a triangle, so we don't want to forget our 1/2. The height there, it goes from 4 to 10, this space right there, so that's 6. And we're still selling 600 units. So now it's $3 times 600, and that's $1,800 that they make from market B. Now the one final thing I want to note here is, remember on our last slide we talked about the deadweight loss when we had third-degree price discrimination, and we said the efficient point occurs where marginal cost equals the demand curve. So if you go back to our previous discussion, this point right here we said was efficiency, and notice that's exactly what our monopolist with perfect price discrimination is doing. The monopolist under perfect price discrimination actually produces the efficient amount. They produce and sell 600 units in both markets, which we saw previously as the efficient amount. The issue here is we don't have a deadweight loss, but all of that benefit, right, this entire triangle, is going to the monopolist. If this was a perfectly competitive market, the market price would be $4, price would equal marginal cost. The same amount would be sold, but that big triangle that is now monopoly profits would all be consumer surplus. So with perfect price discrimination, we get this very interesting case where we get economic efficiency, But actually consumers get no consumer surplus because every single person is paying their maximum willingness to pay.